Income tax 2020. Refund from state income tax. Come in, relax with income tax 2020. Refund from state income tax. When thinking about the income tax equation, we're going to be up top here in the first line item, thinking about the tax equation in two halves, two parts. The first part basically being a modified income statement for tax purposes. The second part being the calculation of the tax on the taxable income, the application of then the payments and the credits to get down to the tax refund or amount due. We're going to be up here on the first half. We're thinking about basically the modified income statement. We're considering income. Two questions with regards to different types of income. One, is it something that I have to include in income? And two, if I do have to include it in income, is it going to be taxed at ordinary progressive rates? Or is it going to have some kind of special tax rate that will be applied to that particular type of income? We're now talking about refunds and refunds that are going to be received. So if we received, for example, a refund in 2020, that basically means that we overpaid in 2021. Now, the confusing thing about refunds is you might say, well, no, that shouldn't be included in income because that just represents an overpayment that you're getting paid back. And that's true. And when you think about the federal income taxes, then we don't include, of course, the federal income tax refund in the first line item. In other words, if I got a federal tax refund for 2019 and now I'm filing the 2020 tax return, I'm not going to include that federal income tax refund in the top line of the 2020 tax return, even though I received it in 2020, because in theory, that represents me simply overpaying in 2019. They gave the money back. It's just a refund. It's not actually income. But on the state tax side, it gets a little bit more complex. And the reason it gets a little bit more complex is because if we itemized down here, if we used itemized deductions, then we may have gotten a deduction for the tax in the prior year. So if we itemized the deduction in 2019, got a deduction for the state tax, and then they paid it back to us, well, now since I got a benefit from it in the prior year as a deduction for federal income tax purposes, that's when we might have to include it then in income. That's the general rule. We'll go into it in a little bit more detail. It can be a bit confusing because of the fact that we have federal taxes and the federal refund that we're considering, and then state refunds, which will differ from, of course, state to state, because states can choose different types of taxes to run their state. And then the deductibility of state taxes on the federal return, which is what really kind of complicates the matter. So what we're going to have here is if you get a refund from the state, you may well then get a Form 1099-G. So you should get then, if you have to include it in income, typically because it's from the state going to you, they would process then a 1099-G. Anytime you get a 1099, you're going to be thinking, okay, this is something that I may need to be including in income. That's basically what the 1099 means. And of course, it also means that a copy of that 1099 went from the state, the payer, to the IRS. So the IRS has it. So if I do not properly record it, the IRS will almost surely pick it up because the computer can do it. They don't need an audit to look into that. They should be able to pick it up and then get back to us. Although the 1099-G, the state tax income, is a little bit more confusing because of these things that were talked about. We'll go into a little bit more detail on it. So the 1099-G, we have the unemployment compensation. That's not what we're concentrating in on here, but you have that on the 1099-G. Then we're concentrating here on number 2, state or local income tax refund, credits, or offsets. And then box 2 amount is for tax year. So they'll give you the tax year, federal income tax withheld. Typically, you're not going to have any federal income tax withheld if you're talking about a state or local income tax refund, possibly if it were unemployment, but we're concentrating here on box 2. And then box 5, RTAA payments, less common, taxable grants down here. That's not where our focus really is at this point. 7, agricultural payments. 8, check if box 2 is trade or business income, and box 9, market gain. And then we have the state information down below. Obviously, we have the payers, name, address, city, and so on the left. Payers 10, and the recipient's TIN, tax identification number, recipient's name, address, and so on and so forth. So we're going to be concentrating, of course, here on line 2 or box 2, which would be the state or local income tax refunds or credits. Now, if you get a Form 1099-G and you have any questions about it, then it should come with instructions to it. And if it does not, you can go to the IRS website, simply look up the 1099-G, and that'll give you some information on a box-by-box standpoint. So if some funny box is filled out, you can, of course, go to the IRS website, irs.gov, look up the form and or look up the instructions, and you should have the box-by-box instructions related to it. On the Form 1040 then, if this amount is going to be included in income, it would be down here on the income line item. I know it's a little small right here, but I want to show the full 1040 so you can see it, and then we'll go into it in more detail when we do the practice problem in a following presentation. It would then be on line 7A. So on line 7A, and then it could be then supported on the Schedule 1, which is going to be attached to it with the tax refund, credit, or offset of state and local taxes. Now let's go into a little bit more of the details of this, because oftentimes if you enter this into the tax software, say this is a new client that you have, and you simply have that 1099-G, you enter it into the tax software just where the data input says, and then it doesn't show up here. You're going to say, it didn't show up. Something went wrong with the software. What's going on? That's a typical kind of scenario that can happen. But really the software is trying to tell you, hey, this thing could be included or it may not be included. It's a dependent type of thing. So it can cause confusion oftentimes with the data input. It also causes confusions with the client when you're discussing to the client why or why not you would be including basically state taxes on the federal income tax return. So let's go into the income tax formula to understand this in a little bit more detail. And this makes sense once you wrap your head around it, but it takes a little while to kind of wrap your head around. So remember, here's going to be our income tax equation. This is the federal income tax equation we have here. Now we have the income statement, we got the calculation of the tax, and then we got the payments that were made. If we overpaid then, the amount, if we overpaid on the federal tax side, we're talking federal tax side, then we would get a refund. So if that happened in 2019, of course, and we're talking federal taxes and we got a refund, then we're not going to get a 1099-G from the federal government telling us that we need to include the refund in income for 2020. Why? Because it represents usually an overpayment. It represents an overpayment of the tax. It's not income, it's simply an overpayment of the tax. Now, so for federal income tax purposes, then the refund, there's no question, it's not going to be included in income. It's a refund, it's not income. On the state taxes, it's kind of the same thing, but the problem is that the state taxes sometimes are deductible for federal income tax purposes. And that's really, in my opinion, where the problem happened. The federal taxes should never have started deducting state taxes on the federal income tax returns. Once it's done, you can't really remove it. I'm not saying that, you should stop doing it now at this point in time. I'm just saying that at the point in time they decided that state taxes should be deducted on the federal return, probably wasn't a good idea, because then that influences the states on how they're going to tax, right? But in any case, that's the way the law is. And again, should we change it? I'm not getting into whether or not or how it should be changed, because now it's hard to change something once it's in place. But that's what really causes the problem, because if you imagine this kind of system on the state, and states have flexibility to tax however they want, then what happens that if you happen to itemize, then you may be getting a benefit from deducting the state tax on the federal income tax. So now you paid your taxes to the state, you may have overpaid, you might be getting a refund from the state, but you're deducting the entire amount that you paid, which would be including the amount that you're going to get refunded on the federal income tax return if you are itemizing. And that's going to be the general problem, because you can imagine a situation where people could take advantage of that, right? If people could say, okay, I would like to reduce my federal income taxes, maybe in December, I will just make a huge payment to the state in December, deduct it as an itemized deduction, and then simply get a refund from the state, and then I will have gotten a big deduction. All I had to do was basically, put a cash outflow now that I'm going to get back later, and I get this big deduction on the federal tax return. You can't really do that, in part because you're going to have to include the income in the following year, and obviously that would be an intentional way to try to deceive. But that's just something you want to kind of think about, why you would have to include the income on the return for 2020. So that's basically what happens. If someone itemizes then, and only if they itemized in 2019, That's the only way that they would get a benefit from the state taxes in 2019, because otherwise they would be taking the standard deduction. If they got a benefit from the state taxes in 2019 and then they got a refund, which they took a deduction for in the prior year, it would make sense then that we have to include that refund in income in this year. Not because it's really income, it is still a refund, but because we took a deduction last year and it wasn't really a fair deduction. We deducted something that shouldn't have been deducted. We deducted something that got refunded, so it wasn't really a payment that went out last year. So instead of us fixing last year's return, instead of us amending last year's return and saying we're going to eliminate the deduction that was taken for the itemized deduction for the portion of the state taxes that were not actually taxes because they got a refund for it, we're just going to solve the problem or fix it in the current year by recording it in income. So they get the deduction, we'll leave that as it is, and then we'll have to record it as income in the following year. That's the general rule. Now, in practice, that becomes a little complex when you have like new clients, and it becomes complex to kind of explain to some people. So mainly now notice that they tried to simplify the code by limiting, one, the state taxes to some degree, and two, they tried to make it so more people are on the standard deduction. So in other words, if someone took the standard deduction last year, then there's no question. Then you just you're gonna, if they got a refund, you don't have to include it in income, because if they took the standard deduction in 2019, then they didn't get any tax benefit from it, and you don't have to include it in income in that case. If they did itemize in the prior year, then it gets a little bit more complex, because the question is whether or not they got a benefit from, and how much that benefit was from the state taxes, to determine the portion of the state taxes that you would have to include. Now, tax software can help with this calculation, of course. So if you have a repeat client and you had them in the software last year and you rolled over the software like a lacert to the current year, then the software will typically make the determination, and you simply need to verify that that determination is correct. It'll be able to know whether or not that they itemized last year or whatnot. But if you're picking up a new client, then you're going to have to make that determination. And usually the best way to do that is to actually take the new client, enter in their prior year return. If it's a complicated return, enter their return into the 2019 software, match it up to what they actually have on their paper return, so that you can roll it forward in the software to 2020. And then anything that rolls forward, such as this itemized deductions or any carryovers, should roll over within the software. That's the best way to do it. But that takes longer to do. And if you're just entering the data directly into the current year, then you're going to have to make this determination as to whether or not the state tax should be included in income or not. And the general rule is this: if they're not itemizing this year, they probably didn't itemize last year. If they didn't itemize last year, it's not going to be included in income because they didn't get a benefit from it. If they did itemize last year, most likely the entire thing would be included in income. However, there are exceptions to that, because it could be the case that they still didn't get the full benefit of the state taxes, and you should only be included in income the portion that was that a benefit was received on. So therefore, the taxable amount that would be then recorded, again, generally, most of the time, it would either, if they didn't itemize, it wouldn't be included. If they did itemize, probably the entire thing, but it may not be the entire thing. So the taxable amount then would be the lesser of the amount received, the amount deducted on Schedule A in the prior year, and the amount by which the itemized deduction exceeded the standard deduction in the prior year. So we're looking at these two. And it could, more likely these times, especially if you're in a high state tax area, because they actually limited the state tax. So it could be the case that that the entire thing, the entire refund, may not be included, and you'd have to do this calculation more so than prior to that law change. But in any case, either the amount received, the amount deducted on Schedule A, so the amount that was deducted, or the amount by which the itemized deductions exceeded the standard deduction. Because the amount by which the itemized deduction exceeded, like if the itemized deduction was just barely over the standard deduction, they didn't get a whole lot of benefit. They only got the benefit of the difference between the standard deduction and the itemized deduction, even though they took the entire amount for state taxes as an itemized deduction. If it just barely put them over the line in order to be able to itemize, they didn't really get the full benefit of it. And so that's going to be the process. We'll take a look at it in a little bit more detail as we do a practice problems with it in a following presentation.